Ladies and gentlemen,
Good evening.
Are you ready?
Okay, here we go.
You're listening to the Deal Room Podcast. Join us as we bring you the inside scoop on business sales and acquisitions. Get across trends in the area and hear the industry's best recount their real-life tips, traps, and experiences. Now, here's your host, Joanna Oakey.
Hi, it's Joanna Oakey here, and welcome back to the Deal Room Podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. In this episode, I'm talking with two brilliant guests, Brett Goodyer and Alex Gilchrist, all about how buyers can avoid the common traps in business purchases and how better due diligence, valuation knowledge, and acquisition strategy can protect and even grow value. Alex joins us from Seek Business, where he works closely with brokers and business owners to connect buyers with the right opportunities. Brett is a business valuation and forensic accounting expert with decades of experience helping businesses make smarter, data-driven decisions. And in this episode, Brett, Alex, and I talk about how to avoid buying a lemon through proper due diligence and the right advice, why not all businesses are valued the same, and what influences valuation multiples, how smart acquisitions can grow business value through valuation arbitrage, and a whole lot more. P.S. This episode builds on insights from our recent webinar, which is now available on demand. Check out the show notes on our website for a link. And why don't you brew yourself a coffee, settle in, and let's kick off with part one of our two-part series with Brett and Alex. Here we go. Brett, Alex, I just want to say thank you so much for coming onto the Deal Room Podcast to continue that epic conversation that we're having in the webinar. There were so many questions that we were just like, oh my gosh, we've just got to have a podcast after it. So guys, firstly, thanks for jumping on that webinar with me. I loved it. And number two, thanks for coming back right now.
Pleasure. Yeah,
Not
great to
at
be
all.
here.
All right. And as I would have said in the intro to all of you would have heard this, if you missed the webinar, not too late, make sure you check out the show notes and we'll give you a link to the webinar. But here I just, as a bit of a preface, we're not going to attack this in any sort of order. So this is going to be a crazy, just run through different questions that have been asked along the way. But so I'm just going to get started. So one question we had in one of the pre-registration questions, and actually I think we had over 700, almost 8,800 registrations in. So we had a lot of questions. So we're not going to even be able to get through them all today. But one of the questions that I thought was interesting is someone asked, how do I make sure I don't buy a lemon? And how do I use due diligence of making in a way to make sure I'm not buying a lemon? That is such a good point, because I think we've all probably seen examples of where buyers have been a bit too excited and perhaps gone into the acquisition process without even thinking about how do I absolutely make sure this is the right business to purchase at the right price. So why don't we go, Brett, why don't you kick that off first? What do you think is most important?
Advisors. The right advisors. That's the first step. I've lost count of a number of times where I have been asked to look at a business after the dog has bolted. We've been asked to come in and have a look at something. They've already agreed, they've already paid, and I have a look at it and I think that they've massively overpaid. Sometimes it's years down the track. I can only think of one time where someone said, my client, because I was talking to their accountant, my client turned up and has bought themselves a candle manufacturing business for $700,000, and it turned out to be a really profitable, great business. And that was really unusual. Most of the time, it's along the lines of my client turned up, they spent $1 million, all of their savings, because they just got canned from, I don't know, Blue Scope or something like that, where they've spent the last 30 years and decided they're going to do something completely different. And so they jumped into an area that they didn't truly understand and massively overpaid before they even spoke to an advisor.
Yeah.
And that's the critical thing here. There's people who know what you should be doing, and it doesn't take much. Usually a 15-minute free consult with you, for instance, would go, hey, have you considered X, Y, and Z? Have you talked to even just your own accountant, let alone a professional who looks at valuations? Have you talked to someone just to do an initial sniff test? That's the thing for me, is there's so many steps to this that often just get completely left by the wayside. A business purchaser should be looking at multiple businesses and then having a look at each of them and giving them all a bit of a sniff, bit of a kick in the tires to work out, okay, these 2 out of the 5 seem to be about what I'm looking for. Take those to an advisor and say, okay, in terms of the quality of this deal, what do you think about the risk and the return of these as an asset? What can we do? What do you think they're going to suit me? And then spend a little bit of money on that initial DD before you then go and spend your life savings, and potentially it just evaporates because you might not be able to find someone else who's going to buy that lemon off you. If it's a bit like the used car market, you'd probably take it to your mechanic and say, hey, could you have a quick look at this before I buy it? Because if the head gasket's about to blow, I'd really like to know. And that's the same thing. It's the exact same process. Building a pest inspection on a house before you buy it, that's standard. But you'll spend $1 million on a business because the broker or the vendor has said, oh no, it's a great deal. And you get excited and you just move. And that's the thing we've got to caution.
And I guess to follow up on that as well, with some of the research that we did at Seek Business, on a sample size of around 4,000 to 4,500 business buyers, we saw that people were still putting their friends and family above professional advisors when it came to who they would go to advice when they're buying a business, which is really interesting. And obviously, if you invest in professional advice, you're going to get like a 5 times return or 10 times return compared to if you're just listening to some advice you see online on social media, which is really kicking off these days, which I'm really surprised about. And the other part with talking to friends and family, obviously extremely important to get their buy-in, but there can be a bit of tall poppy syndrome in that as well, where they'll pull you down and you never make the leap into actually buying that business as well, when it could go on to be life-changing and really, really good for you and them. So yeah, just to back that up, and actually the other thing as well, which I wanted to call out, was when speaking to some of the business brokers that I talked to, it's even getting the advice from people who are in that right industry or that right type of business. It could be a lawyer, or it could be an accountant who doesn't specialize in that particular area. And this is just what I'm hearing when I'm on the road. Obviously, I'm not a professional business broker or a lawyer or a valuation person. This is just some of the advice I hear when I'm speaking to business brokers. It's getting the right industry expert as well.
Yeah.
Look, I actually noticed in one of the questions that came up, it was, how do accountants and business brokers get valuations so wrong? It's because valuations isn't that easy. It's a bit tricky. And people who say, to go to their own accountant and say, what's this worth? And they've never valued a business in their life. They look it up. They might even type something into ChatGPT. And we all know that's not particularly useful across all types. And so all of a sudden I guess they fake it till they make it, and they give some pretty dodgy advice. And I guess that's it. It's exactly the same thing. You have to get the right advice from the right people to hang your hat on it if you're going to be making a decision that is life-changing. Like, it's important to get good, unbiased, expert advice.
And can I just say, we're actually seeing quite a bit at the moment, and particularly actually over the last couple of years, with inquiries coming into us from people who have bought a business. So we've not acted for them, but they've purchased a business in some other way. The business hasn't performed, and now they're trying to work out what they can do about it. And part of the issue is there's a number of things. There's due diligence, making sure you understand what you're purchasing. But the second thing is setting the contract up, the deal structure, the structure of the deal, when you pay the purchase price, whether there's any money that you're holding back to ensure you get key assets transferred, or the revenue that you expect to be there is realised in the future, triggers. It's all of those things that are absolutely critical to get right in the transaction, because after the transaction's done, after you've finished due diligence, signed the contract, got all of that in place, it's too late if you've not got that set up in many instances. And the difficult thing is when people think they've bought something and the value that they think is there isn't there, it can be absolutely devastating. It can be because quite often buyers will be financing their acquisitions as well. So it can be business and life destroying not to make the big financial decision, having undertaken the right checks and then having the right contract in place. I just want to add one other thing. It's quite interesting because quite a few approaches we've had where issues have come up have been people who otherwise thought they were good with financials. And I just want to say that being good with financials is not the same as being able to assess a business and to understand what the value of the business is. And I find, like, whether it's an accountant that, with purchasing the business, but hasn't had a regular experience of purchasing businesses, doesn't exactly know what they're looking out for in that space, or someone that otherwise think that they're more sophisticated buyer in the acquisition, but without actually having had that right advice next to them. I don't know, do either of you have anything to throw in there?
I agree 100%. Yeah, there's plenty of people who can look at a P&L and understand what the profit is, but they have no idea how you might get to a position of trying to determine what the earnings are into the future. And on a normalized basis, that idea of getting it back to what an arm's length owner might earn as a return on investment, which is how you value businesses. They just never have considered that. And I don't know how many times I saw in that chat was, how do I account for cash in a valuation where the cash never hits the books? Here's a tip. You don't. You can't have both. You can't have it both ways. You can't pull cash out of a business year on year, and then when it comes time to sell it, go, oh, actually, don't tell the tax office, but there was an extra $100,000 a year profit on top of that, so I want my multiple times that as well. No, get one or the other. You can either have the book value or you can have the cash, or one or the other.
Yeah. And I think one of the things I really also noticed in the chat, but also really in the questions that came in before the webinar, was like the concern about identifying red flags. What are those red flags? How do we know what to look out for? And I guess, Alec, throwing to you, from SEEK's business market data, have you noticed any correlation between business characteristics and difficulty selling or lower buyer interest that might serve perhaps as a bit of an early warning sign?
Yeah, so while our data doesn't directly measure problematic businesses, we can identify several patterns that potential buyers should be aware of. And so firstly, on Seek Business, if there's a listing on there for an unusually long time, it usually can represent underlying issues. So on Seek Business, the average listings to sell usually take around 90 to 120 days. So when a business has been listed significantly longer, it could indicate unrealistic pricing or undisclosed problems. Second, we also see lower interest buyers in where there's businesses that lack financial documentation or there's a problem with transparency. So listings with detailed financial information typically receive 30 to 40% more inquiries than those with very minimal data. So I guess buyers should be cautious of sellers reluctant to share comprehensive financials. And third, businesses that are heavily dependent on the owner tend to attract fewer qualified buyers and often sell for lower multiples as well. That's just some of the advice I've heard when I've been on the road. So Brett could probably talk to that a bit more, but our data shows businesses marked as under management or with strong operational teams consistently attract more interest.
I just want to throw in really quickly there, because really interesting two things you touched on that I thought I just wanted to highlight. Those listings that have been there for a long time, one of the things that I see repeatedly in the market is sellers who aren't prepped for sales, so don't have a good understanding of what value of the business is and what their value is likely to be, come onto the market with unrealistic expectations. They come onto the market with, what do I want out of from the sale of my business, not what is my business objectively worth. And I think that can be a reason for that long listing time. The second thing I want to add there is sellers being ready, just like buyers being ready. Like, actually, this is a message to both ends of the market, but sellers not being ready for due diligence, for the listing process, for the questions that a buyer is going to ask, you're just wasting your time. Right? Because buyers, absolutely red flag for buyers, if you can't come up with information quickly or the information you come up with is not clean. So I don't know, Brett, whether you have any thoughts on that as well.
I wrote a book on it. One of the things that I've noticed is that there's a correlation. Like if you haven't prepared for sale, then you're not worth as much. It's just 100% true. Okay. So it's preemptive due diligence, preparing a business for due diligence before you go to market. There's a direct correlation with an uplift in value. It simply is what happens. So even your book touches on this same sort of information in that we're talking about, okay, if you want to exit a business, then you prepare it for exit and you will get an uplift in value. That's why you buy a business. It's an asset. You want that asset to appreciate as well as give you regular returns. So the thing you do with an asset is, if it was a house, fix your bathroom. You'd do all of those different things to improve the property. In the case of a business, you try to do the exact same thing, but in a slightly different way. So you document things. You start doing cash flow forecasts and budgets. You document a business plan that says, this is where my business is going over the next 3 to 5 years. This is how I'm going to achieve it. This is the marketing plan. This is everything I'm going to do about it. A part of a comprehensive business plan is the exit. Every business owner has to get out of their business at some point. So prepare. It's not simple. Get ready for it. Because the difference between a business, two businesses that are exactly the same, they both turn over $1 million. They both earn $300,000 a year. But one of them has a comprehensive business plan that includes documented systems and procedures and cash flow forecasts and all this information, so that when they walk out the door, they can pass it to the new purchaser and say, here you go, there's the blueprint to continuing on into the future. Or you have the one next door that has none of that. Are you going to pay the same amount? The answer is obviously no. You will pay more for the business that has a lower risk because it's got a blueprint for the future. And that's what due diligence is really about. So if you can preemptively answer every question before anybody ever asks it, then they're not going to ask it. And it becomes a simple process. And that's the massive difference between a prepared business and an unprepared business. And there's so many times that from a forensic accounting position, why I get asked on the stand by a barrister, why did this business get valued in this way? Every single time it comes down to, they're not prepared for sale. It's not the same as this business that sold for 5 times its EBITDA for the following reasons. It doesn't have cash flow forecasts. It does not have systems and processes, and it is entirely reliant upon its owner. The owner can't step away from this business for a week without it falling in a heap. And you're expecting to just walk out and someone else takes over? It's not going to happen. So it's worth, let's say, 2.5 times. It's half as valuable. And it's trying to get that principle of preparedness into people's heads. And so when someone says, oh, how do I account for cash? It's too late. You should have been accounting for cash 3 to 5 years ago when you took over this business. You put the cash back in where it's supposed to be. You pay tax on it, and your business will improve in value.
I just want to make a call out. You're talking about your book. So we will put a link to the book in the notes, and fabulously titled Beyond the Bullshit, a no-nonsense guide to business valuations. And like you said, written a book. It's Battle of the Books here, Buy, Grow, Exit. Of course, we'll put a link there as well. And Seek have got a fabulous market insights report, and you can sign up there for free and get market insight on a quarterly basis. Fabulous report there, Alex, that all our buyers and indeed sellers and business brokers can get access to. Okay, so we've talked about red flags. We've talked about ideally not buying a lemon. Where are we going to go to next? Okay, EBITDA multiples. Multiples as a whole, like that drew a lot of questions, both in the webinar, but also in the chat. I'm not even sure where to start there because there was so many questions. Here's one. I love this question. Why don't all businesses have the same multiple? And I just think it's really good to start high level here. Let's cut it down and talk about it in a really in the easiest sense possible, what's like the easiest way you think you can communicate about what that ultimate difference in multiples is showing?
I think that example I just gave you a moment ago, like if you had two cafes, they were on the same street and they both served very similar food and coffee, and they both turned over the same kind of money and made the same sort of profit. But one of them had the owner not working in the business at all. It was completely run under management. And they had a systems and procedures file so that if a new employee came in, you could just go, okay, this is your role. Here it is. Have a read, work it out. We'll then give you the training required and we're off and running. And so that speed up, the getting them up to speed might take 2 days. And then you have the other business, which ostensibly is the same. And it has an owner that's pulling 80-hour weeks and is not paying their taxes properly and all these other different things that don't have a systems and procedures manual. They don't have the risks being managed. They are not worth the same amount of money, even though they both earn the same amount, because the amount of effort required to maintain one over the other is vastly different. And at the same time, you have to work in one and not the other. So the difference is simply how risky is it to step into this business, take it over and continue earning the money, but also how much effort do I have to put in, especially in that smaller end of the market where we're talking small to micro businesses, where the amount of effort required is directly correlated to the owner. Now, if they have to work in the business and work their guts out, it's very different to one where there is no owner working in the business. So that's what it comes down to. It's simply risk and reward. And there's thousands of different options I can give you here. But one of the things that we'll see, for instance, is accounting firms have over years developed this rule of thumb methodology of valuing themselves, which is cents in the dollar on revenue. But it's a shortcut method. And what it's doing is essentially saying, I'm going to pay $1 for every dollar of revenue that is earned. And so it turns over $1 million, I'll pay $1 million for it. And the reason that developed is that most accounting firms over that period were making about a 30 to 35% return. So that was the equivalent of a 3 times multiple. So it was just shortcutting the process. But the problem with that, and that carry on into the post-revenue cents in the dollar sort of world, is that if you looked at 2 different businesses that were both turning over $1 million, but one was making $150,000 profit and one was making $350,000, then you ought not to be paying the same amount for them. Because whilst they're earning the same, their overheads are different. And it's no different when you start looking at risk. Okay, how risky is it that I lose my key employee who is responsible for 50% of my fees? If it's super risky, then, we're not going to pay the same. Or let's say it's a manufacturing company who's got only 10 customers. If they lose 2 or 3 of them, they are now essentially insolvent. Whereas another manufacturing company does something very similar, but has 1,000 customers, they are not the same because they've got that diversification of income. And so every single one of those considerations lets us build a picture of risk that allows us to then say, how much would I be willing to pay for that income stream that's derived from this business type?
And I think the one thing to throw in there as well is across, you were just talking about what different industries do and how different industries work in terms of base valuation approaches. Because there are movements. So accounting industry, yes, there's a particular approach that many people in the industry will adopt to valuing an accounting practice that's different to if they're valuing an event practice or a legal practice so I guess that's another point of the important thing is to understand the industry and the market that you're buying into and the way valuation will happen within that business, because valuation is not just a function of the business in and of itself, it's also business within the industry that it sits in and the way that it operates.
With the economy as a whole. Yeah.
And actually, when I was having this discussion just yesterday with a buyer, and I was saying, I think it was with a buyer, and I was just talking about this. I had a podcast ages ago where I talk about, I love the concept of growth through acquisition. And we saw a lot of people on that webinar today who were looking at, also in the Seek Data, I think, Alex, we talked about who were looking at acquiring a business as part of their growth plan rather than just organic growth. And I just think, like, really interesting when you have people so business owners who are looking to sell. And I had an episode talking about all about the benefit of acquiring before you sell to increase your size and potentially also increase the multiple. And so then I had this seller approach me, and he said, oh, look, I've been listening to your podcast and I was going to come to you to help me with the legals of selling the business. And then I pulled out of the sale because I thought, actually, maybe I'll go and have a look at buying a business, get my head around the values in the industry first. And he went in, had a look at the values, what's there sitting in the market. And he said, oh my God, this is amazing. I'm being told at the moment, I'm looking at a sale on the basis of 4 times my EBITDA. I'm sitting here, I'm seeing businesses for sale at 2 times. I reckon, because I know that business, I can roll them in immediately and get that increase in the value of the 2 times to the 4 times once. And we call that valuation arbitrage for acquiring a business and then being able to get the uplift in the value. And he did that. He went out and did that. And I thought, I love it. That is absolutely epic, because it's rare that lawyers get the opportunity to help guide people in ways for growth of the business. And really is an opportunity, isn't it? But it just shows you how those multiples can, even within the same industry, act differently depending on the size and other characteristics of the business that you're talking about. Right?
Well,
Love that.
have a look at those slides that we did in our webinar, and I was showing you what the multiples look like for businesses that were turning over less than $1 million, and for businesses that are turning over less than $5 million. We have data post $50 million revenue. And you'll see that the growth in the multiples is significant between each of those. And so one of the things I've always recommended is aggregating. Growth by aggregation and acquisition is you cobble 2, 3, 4 businesses together and ensure that they're now running as a cohesive whole, that you might have paid 2 times for them, but you can sell them for 6. And that's what private equity does. But they're doing it on scale. And they're usually starting with bigger businesses to make very large businesses. But there's no reason why we can't be seeing that in this SME market much more often.
That's exactly what I think, Brett. I just think it's the real opportunity out there. And I get really excited when I see things like this, because I think SMEs so often just don't get the access to the sort of information that corporates, because corporate Australia, corporates all around the world use M&A for that exact reason, for growth. But it's such an opportunity that's untapped to the potential that it really is. Anyway, I could talk all day about that. Of course, I've got loads of content on growth through acquisition. Now, I cover it in the book as well, of course. Well, that's it for this episode of the Deal Room podcast. We hope you're now primed for your next deal with these pointers and have enjoyed these fascinating insights. Now, if you'd like more information about this topic, then head over to our website at thedealroompodcast.com, where you'll be able to download a transcript of this episode, as well as access any contact details and any other additional information we referred to in today's podcast. Now, if you'd like to get in contact with our guests today and the services they offer, you can go ahead and check out our show notes for a link right through to them and their details. You can also book in directly with our legal legals at Aspect Legal if you'd like to soundboard your next steps, discuss a legal question, or find out more how we can assist, whether that's with buying or selling a business, or perhaps somewhere in between. Now, don't forget to subscribe to the Deal Room podcast on your favourite podcast player to get notifications whenever a new episode is out. We'd also love to hear your feedback, so please leave us a review and rating if you're already one of our subscribers, or even if you're listening to this podcast for the very first time. Every review helps our team produce valuable content for you. Well, thanks again for listening in. You've been listening to Joanna Oakey and the Deal Room podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. See you next time.
Ladies and gentlemen.
That will conclude this evening's entertainment.
Thanks for listening to the Deal Room Podcast. To find out more about this episode and other episodes in the series, check out the show notes or head over to our website at thedealroompodcast.com.au.